That is the brutal truth of equity research. You are not placing the trade. But your rating, price target, and morning note can change what people with billions decide to do. To outsiders, it looks like research. To the market, permission. Level 1. The invisible associate. You are 22 when you walk into equity research for the first time. On paper, it feels like you made it. Your title says Junior Research Associate at a major Wall Street bank. Your team covers semiconductors, the invisible layer under artificial intelligence, cloud computing, smartphones, and data centers. But inside that room, you learn the first cold truth. You are not important yet. Your name is not on the report, your voice is not on the call, your opinion does not move a stock. At this level, your job is to keep the machine from breaking. 14 companies, 14 models. From the outside, it looks boring. But inside equity research, one wrong number can become a wrong price target. One wrong assumption can become a wrong rating. So you read earnings transcripts, 10Ks, 10Qs, investor decks, competitor notes, and calls where one CFO avoids one sentence too carefully. At first, every acronym feels like a locked door. But after enough repetition, the numbers stop looking like numbers. They start looking like behavior. Then one night, at 11:47 p.m., you are checking accounts receivable for a company your team rates buy. One number does not behave the way it should. You check the formula, the prior quarter, the 10Q, the transcript, the model again. The number is still there. Receivables are growing too fast against flat revenue. Maybe it is timing. Maybe it is nothing. Maybe you are too junior to know. But if you say nothing and you are right, the report goes out with a conclusion built on a number that should not survive. At 12:19 a.m., you send Chen one short message. No drama, just the pattern highlighted, and one line explaining why it may matter. You hit send. No applause. No response. Just silence. That is level 1. The first level of Wall Street does not teach you how to speak. It teaches you how to see. Level 2. The second name. Chen replies the next morning at 6:43 a.m. 2 words. Good catch. That is all. But to you, those 2 words open a crack in the wall. The team delays the note. Later, the company discloses weakness your model had started to show before management said it out loud. And for the first time, you understand the difference between doing work and seeing something. Work gets assigned. Seeing something gets remembered. After that, Chen trusts you differently. You sit in more calls. You hear management explain bad quarters with polished calm. Then one day, your name appears under Chen's name on a report. Nothing changes immediately. Clients do not suddenly call you. The market does not care. But you know what it means. If the report is right, your name is attached to the accuracy. If it is wrong, your name is close enough to the mistake to feel it. That is when you learn the second language of equity research. The first language was numbers. The second language is silence. At an investor meeting, a CFO pauses for 2 seconds before answering your question. The pause is not confusion, it is calculation. But even with your name on the report, you are still not the voice. You are the second name. If you want to truly exist, the buy side has to call you, not Chen, you. Level 3, the ranked analyst. The first time a portfolio manager calls your direct line, you almost miss it. Not because you are busy, because you are not used to believing the call is for you. For years, the important questions went to Chen. The urgent calls went to Chen. The client relationships were Chen's relationships. Then one morning, a portfolio manager from a large asset manager calls and asks what you think. Not what Chen thinks, what you think. And that is when the pressure changes. You can no longer hide behind the model. You have to say what the numbers mean before the answer is obvious. As an associate, you were lonely because you were invisible. As an analyst, you are lonely because people can finally see you. Every earnings season, your phone becomes a scoreboard. If clients call, you are relevant. If they stop calling, you feel yourself disappearing. Then the ranking survey arrives. First team, second team, third team. You tell yourself you do not care. Then September comes, and you care, because the ranking is proof that your calls mattered. But once you want recognition from the market owns part of you. Your biggest competitor is not another analyst at another bank. It is the person who taught you how to become one. Level 4, the mentor ceiling. Chen taught you almost everything that made you dangerous. He taught you that a model is not a spreadsheet. It is an argument with numbers attached. He taught you that a weak question gets a polished answer. But a precise question can make a CFO reveal what the prepared remarks were built to hide. For years, you are grateful. Without Chen, you would not read the sector this way. You would not write notes clients finish. You would not understand that calm on Wall Street is not personality. It is a weapon. But slowly, mentorship starts to feel like gravity. Because the same person who taught you how to rise is also the person standing above you. Not cruelly, not unfairly, structurally. There is only one first voice at a firm, only one name clients think of first. And in semiconductors, that name is still Chen. Even when you are right, part of the credit flows upward. Chen's team is strong. You are not angry at him. He respects you. He trusts you. He gives room. That is what makes it harder, because the ceiling is not made of disrespect. It is made of history. So when another bank offers independent coverage, the real reason is simple. You need to know if the market wants you. Not Chen's associate, not Chen's second name, you. Like and subscribe here, because the next level is where your name becomes public, and public power always arrives with a cost. Level 5, the public name. At first, having your name first on the report feels like oxygen. No shadow, no second position. No opinion passing through someone else's reputation. Now clients call for you. Portfolio managers want your preview. Hedge funds want your read. Then the ranking confirms it. First team. Your name at the top. For one clean moment, it feels like a rival. But once you become the public name, you do not just earn the ranking. You have to defend it. Every rating change becomes a test. Every price target becomes a number someone can circle later and say, "You were wrong here." Then the buy-side offer comes. More money, quieter power, no public rating, no public sentence. For a few days it sounds peaceful. You imagine being wrong inside a portfolio instead of wrong on a report. But then you feel the discomfort. After years of public accountability, you are not sure who you are without the sentence, without the note, without the rating. So you decline. Not because the buy side is smaller, it is not. You decline because you cannot fully respect a truth unless you are willing to publish it. Then the market gives you the most dangerous gift it can give a public analyst. It makes you right. Revenue beats, gross margin beats, guidance holds, your buy rating was right, clients are happy, the stock moves higher. The story looks clean, almost too clean, so you go back to the model because one number feels too perfect. Gross margin improved more than it should have. You check mix, pricing, sourcing, leverage. Nothing explains it fully. Then you read the footnotes again. Page 47. A one-time licensing settlement lifted reported gross margin and made the quarter look more exceptional than business really was. It is not fraud. That is what makes it harder. It is legal. It is disclosed. It is sitting there in small language, where it is allowed to sit. If you say nothing, your call looks brilliant. But if you adjust for it, the story changes. Not from good to bad, from exceptional to merely strong. And on Wall Street, that difference is enough to make people angry. So you write the note carefully, you keep the buy rating, but you show normalized margin without the one-time item. The note goes out. The stock drops. Not a collapse, just enough for the phones to light up. One client asks why you would complicate a winning call. And that is when you understand the highest level of equity research. It is not calling the stock correctly. It is telling the truth precisely when the truth makes people uncomfortable. Years later, you become director of research. Your name is no longer first in the morning. Now you train analysts. You review notes. You protect the sentence before it goes out. Your job is no longer to be the smartest person in the report. Your job is to build a system where the smartest sentence is still allowed to survive. Then one morning, Priya sends a model with one short note. Accounts receivable does not match the pattern. And everything comes back. The late night. The empty office. The first time a number felt heavy. The fear of looking foolish. The fear of being right. You open the file. You start from the beginning. Because the names on the report can change. The title can change. The person client's call can change. But the responsibility does not. If this video helped you see equity research as more than stock picks, like, subscribe, and comment which level carries the most pressure. Associate, analyst, managing director, or director of research, because the market may forget a price target, a rating, a quarter, and the day the stock moved, but it does not really forget the person willing to put their name next to the truth.